Robert, if I said what's more important, Powell or the CPI data on Thursday, what do you say?
That's a great question. I think obviously both are important, but I think with Powell, usually in these testimonies, he tries to stick the company line a bit, not drift too much from where their communication has been in recent weeks. And so I'm not looking for anything earth-shattering there compared to recent comments from Fed officials. So I think it comes down to that inflation data later this week. But I wouldn't shy away from also saying that the jobless claims are important, too, because I think we are seeing some signs that things are softening in the labor market, and that is one of the best real-time indicators of what's happening there. So I think all of them are really important.
Do you feel like the narrative is shifting from prices to growth? And is that a good thing? As in worried about growth rather than worried about inflation?
I think naturally, as we've made a lot of progress on inflation over the last several quarters, and growth is moderating, you start to see those risks be more balanced in terms of the conversation. For the Fed, early in the cycle, it was all about inflation. Now, as you said, it's about growth and inflation. Now, there's still risks on both sides. We're still seeing, even though we've gotten some better data in the U.S., still pretty sticky services inflation throughout this year. That's still a concern. But certainly, given the softening we've seen in a lot of labor market indicators, it's catching the Fed's attention. They have to watch that side more, too.
But we kind of knew we were going to get to this point. I mean, you talk about kind of that switch from just focus on inflation or growth and now having to look at both. But we kind of knew that equilibrium was going to be where the hardest part of this was. So it gets to the point now where Powell has to be much more communicative, or at least maybe a better communicator, maybe not more communicative,
more,
but,
oh my God.
but better at communicating
Yes.
kind of what the Fed is going to do, or at least what its thinking is. And I think that's what's causing the market a little concern is they don't seem to be getting that just yet.
Yeah, absolutely. I completely agree. And as you said, we always knew we'd get to this point, and the Fed hasn't necessarily done the best job of communicating how they're weighing both legs of those mandates and how concerned they are about the growth side of the mandate. You know, they are saying they're starting to see some softening. I think in the Fed's mind, they're still getting that soft landing that they were hoping for. But it's not clear, for example, as you said, if inflation continues to come in sticky and growth is slowing down, how they would respond. We think that they're going to cut in September. Yeah. I think even if growth is resilient, there's enough progress on inflation to get that cut at that meeting. Yeah. But after that, it becomes trickier.
So, Rob, I got to ask you, though, a little bit, I mean, about what's going on outside the U.S. as well. There's a lot of focus on the U.S. economy and its health, but Europe is going through a lot. I mean, we just had really two big elections, if you want to put the UK in that basket as well, that probably went in a different direction than maybe what some people thought, certainly in France. And I'm curious as to how you model that in terms of global growth, whether that ends up being additive to global growth or maybe potentially a headwind for it.
Yeah, absolutely. And as you said, we've seen a lot of surprising election results this year. In general, they've kind of been against expectations and against incumbents, or at least incumbents have come in weaker. Right now, in terms of the trajectory of this year, I think it's creating some uncertainty, especially in markets. But really, the underlying engines of growth in those economy aren't going to be too moved, I think, by what happens in these elections, at least in terms of the outlook for the next few quarters. I think beyond this year and in the coming years, how these elections shape up and what they mean for policies like migration flows, government spending, I think those shape the outlook very significantly beyond this year. But right now, I think the balance of mix is similar to the U.S. Is inflation going to come down, and is growth going to be resilient based on the domestic engines that we're seeing rather than policy?
But something that I think that treads through all of them, whether you're looking at the Labour Party or what happened in the French Parliament or here, is we're just going to spend more money. Like, governments will be spending more money, like whether you like it or not. Whether we get a President Trump or President Biden, like their policies might be different, but the spending is still there. I mean, is it just like a steepener no matter what then at this point? Like, are we in for just global spending from developed nations, full stop?
I think it's a great point. And as you said, I think that's the balance of risk. Now, there's some question marks somewhere. I think in France, there's more of a risk of a political gridlock, a little more uncertainty, but the balance of risk is certainly towards more spending. And in the U.S., I completely agree. I think we saw some people saying with market movements that Trump was going to be more inflationary than Biden. Maybe Trump was going to ride larger deficits. I think deficits are going to be large in the U.S., no matter if it's Trump, Biden, or someone else in the Democratic Party. I think that's the mode of operation that we're in. And really, for the U.S., until markets tell them that they can't spend more and you start to see a more significant term premium, I think that's going to continue for the foreseeable future.
What does that look like? Like, What level on the 10-year is that?
You know, we wrote this large fiscal report last year, and one of the bottom lines, at least for the U.S., is we don't know. Nobody really knows how much debt is too much debt. You know, the U.S. has a lot of special factors, largest economy in the world, reserve currency, but eventually you hit some point like that. We don't know where it is. It's probably not prudent to keep pushing up against that point.
Yeah.
But for now, the market seems to be willing to absorb it.
Well, I am curious. It's funny you bring that up, too, because a little bit earlier we were talking about our folks who host the Odd Lots podcast,
Yes.
Joe Weisenthal, Tracy Alloway. They had a great sit down a little bit earlier with Warren Mosler, who's, of course, kind of the godfather of a modern monetary theory, something that has been thoroughly criticized by a lot of folks. But he's now even criticizing at least the contours of it, not necessarily the core of what it is, but the way it's been executed. And his fear is that we are at that point where the deficits and, more importantly, debt servicing has gotten a little bit too out of control. So even if he's concerned about it, shouldn't we all be?
Yeah, I completely agree. Yeah, absolutely. And as you said, and it's interesting, if you go back several years ago in the U.S., as you noted, modern monetary theory was really getting some tailwinds. Most of that has died off, but at least operationally, that seems to be, to some extent, what the government is operating along. They keep spending and spending, and the market keeps absorbing it. And just because it keeps absorbing it now doesn't mean we won't eventually run into problems. But you know, another point that we raised in that report was politicians don't have much incentive to cut spending or cut deficits because the drag on growth is pretty large. So until markets tell them they can, I mean, and also look what happened in France. Those pension reforms were very unpopular.
That was about like
there's
what,
a political cost to it.
Yeah.
Yeah, absolutely. Yeah.